I'm the I am the CEO of MarktoMarket, as Louise says, and MarktoMarket is a business I founded 4 years ago. It's a private company data platform that helps customers like PEM identify, analyze, and value companies. And actually, PM was one of our earliest customers, so I'm very grateful to them and to Louise and Cambridge Network for inviting me along. So what I'm going to talk about first, let me just bring my slides up, and I'm just going to put this onto, there we go. Sorry, everyone, if you could just bear with me. Okay, great. So what I'm going to talk about first is just what
back. Sorry, Doug, it's just flicked back to the non-presentation, the notes view.
Ah, okay.
It was there for a second.
It was there. Let me put it back on here. There we go.
There we go.
Okay, so what I'm going to talk about first is just sort of what we've been seeing in the M&A market over the last 12 months or so in terms of deal volumes and pricing. And this is data that we collect through our team of analysts, and our customers help us here as well by submitting data. And if you look at the UK M&A market, we think that if you look at long run historic trends, you'll see about 300, 350 deals per month completed in the UK. Over the last 12 months, it's been a very different picture, and it's been a very different picture for two principal reasons. The first reason is, of course, COVID, and we saw a sharp decline in the number of deal completions in April of 2020. So deals more than halved as negotiations broke down because people didn't know what was going on with COVID. How do you price something in this environment? What's happening to underlying trading? So deal volumes halved. Activity started to pick up again in September of last year, and then started to accelerate. And you can see this kind of outlier in March of 2021. And the reason for that was that there was another driver as we approached the end of the first quarter in 2021, which was the anticipated changes to entrepreneurs' relief, which didn't actually materialize. But still, that any vendor that was sort of considering selling, that sort of accelerated the process for those vendors, because they were naturally concerned about having to pay something more than 10% on their capital gain. And then you can see that after March, it kind of normalized again, but albeit at a bit of an elevated level. So we went down to 430 deals in April, 382 deals in May. And I would say this feels like a kind of, if I look at June volumes, July to date, this kind of 350 to 400 deals plus per month feels like a new sort of normalized level. And there are a few drivers, we think, behind that elevated level of activity, which I'll talk about. So that's deal volumes. If we now look at valuations. So what we're looking at here is this is quarterly EBITDA multiples over the last couple of years, just to show a bit of a long-term trend looking back 24 months. These are median multiples. So as you will all know, that multiples will vary materially from deal to deal based on lots of different factors. But what we do is we put all of the deals in a bucket just to look at how the market is trending overall. And what you can see here is if we go back to the beginning of this chart, it starts in the first quarter of 2019. You can see this kind of 7 to 8 times level. Actually, the sort of what we call multiple expansion, multiples started to expand. People were paying more for assets. And then you can see that the first quarter of 2021 and the second quarter of 2021, multiples came off. And that appears to be the COVID impact. But what I think is really interesting is that they rebounded very quickly. And by the end of the last quarter that we've recorded, certainly on this chart, multiples were trending above 9 times. Median EBITDA multiples were trending above 9 times. So there was an impact. COVID did hit multiples in the market, and of course there were variances from deal to deal. Having said that, multiples corrected very quickly and started to expand again. So that's what's been happening over the last 12 months there. And if we just now sort of look ahead a bit in terms of trends, so we've got, this is our June data. So we've got a mean EBITDA multiple of 8.7 times, a median of 7.3 times. I think there's a general consensus at the moment that valuations of all assets are pretty elevated at the moment, but feel like they're kind of sustainably so. And we think there are a number of reasons for that. I think the one that is quoted very often is the amount of capital that is out there in the market waiting to be deployed. So you often hear about this $1 trillion of what's referred to as dry powder, which is private equity capital that is waiting to be invested in companies. And by and large, that capital is sitting in 10-year limited partnership funds, and it has to be deployed. So it has to be spent. So you've got this huge wall of capital out there that has to be spent, which is supporting pricing. What we're also seeing is, in terms of the types of companies that are proving popular, that it may be a bit of a bifurcation in the multiples that are being paid for companies with very attractive characteristics versus those with perhaps less attractive characteristics. So if you were to take something like anything that you could classify as, let's say, a COVID winner, so anything that performed well throughout COVID, those were the first assets to see their multiples expand. So anything that was and it's not necessarily sectors, it could be the business model. So anything with a subscription model, you would expect to cope well with short-term volatility. Prices were very elevated and are very elevated for those sorts of businesses, nice, visible, recurring revenues. And then anything with a kind of a digital slant to it. So, but retail obviously suffered. Traditional bricks and mortar retail with enforced store closures, but actually digital retail did very well. And then you saw digital retailers taking advantage of the travails of bricks and mortar retailers by picking up assets cheaply. And the strategy will be to turn those bricks and mortar retailers into online first, or indeed online only retailers. And then the other thing that we've seen recently that we think is going to keep markets very buoyant is buy and build strategies. So that's probably a familiar term to some of you, but it's where a private equity buyer buys a platform asset and then accelerates growth through making small bolt-on acquisitions. And you can buy, if you're paying 10 to 12 times for your platform asset, you can add smaller bolt-ons for 5, 6, 7 times EBITDA, and you immediately get that kind of valuation uplift as you bolt those earnings on to your larger group. So we think there are plenty of forces in the market at the moment to keep markets buoyant, both in terms of the volume of activity happening and the pricing in terms of what is being paid for assets in the market at the moment. And so with that, I will hand over to Lake.
Thanks, Doug. Good morning, everyone. And I will now do a bit of sharing, hopefully, of the right screen. Yeah, good morning. My name is Lake Falconer. I'm a partner at PEM Corporate Finance. We advise owner-managed businesses on M&A, buyouts, succession, and business valuation. And we look at valuation very much through a practical and commercial lens. In fact, I used to say valuation was only of interest to academics, tax accountants, and the divorce courts. But it is the jumping off point for a conversation about the price that someone might pay for your business. So in reality, it is really important. And my focus today is to try and give you a practical take on valuation. And in this session, a whistle-stop tour of the topics you see on the screen at the moment. And in my second talk, I'm going to try and give you some ideas on valuation and making your strategy work in a way that might help you grow the price of your business. So first off, some valuation methods for established companies. I'm going to canter through 6 methods you might come across. This will be a recap, I'm sure, for many of you, but hopefully helpful. The first and the most often used by us is the market approach. This is basically using multiples in some form, usually EBITDA multiples, sometimes revenue. EBITDA, of course, is earnings before interest, tax, depreciation, and amortization. It's a pretty good proxy for cash flow, hence it's a good metric. And the idea is you can get the value of an asset by observing the values of similar assets that people have sold in the market, and assuming that a prudent investor will pay no more for something than he could pay to get something similar. Seems fair enough. 2 ways to do this broadly, looking at comparable companies or comparable transactions. Comparable company method looks at the prices of quoted companies that are comparable. The aim is to build a basket of them and to get a usable mean or median multiple. Of course, these are big businesses, and so the multiples tend to be discounted to take account of the market quote and also the sheer size of them before using them with SMEs. Then there's the comparable transaction method. This looks at multiples actually paid to buy and sell companies engaged in the same or similar lines of business. And this is where we use Doug's data MarktoMarket to see what's actually going on. And again, the aim is to get a basket of comparables. Again, you need to discount them, in this case, for the transaction premium inherent in the deal, and often for scale as well. Then there's the income approach. This is basically discounted cash flow, which many of you will be familiar with. Take a forecast of future cash flows generated from the business into the future, which is then used to calculate the present value by discounting it at a rate that reflects the risk profile. All very well, but for most SMEs, the lack of decent forecasts beyond, say, 1 or 2 years out makes it quite difficult to use in practice other than as a sanity check. And then the other problem you have is it's quite sensitive to the terminal value, the price you forecast to sell the business at in 3, 4, 5 years' time, which is pretty subjective. So don't get me wrong, we do use DCF in specific cases, but generally in the SME arena, with discounted cash flow, as the saying goes, you can torture the numbers to prove pretty much anything you like. The asset approach is what it sounds like. Typically, we'd use that for asset-heavy companies like property businesses. For a trading business, you typically only use it if it wasn't making a decent return on its asset base, because otherwise income and market methods will give you a better and indeed a higher figure. If you are using it, you need to consider adjusting for tax and anything else needed to bring the assets up to market value. So, for example, I valued a bus company a couple of years ago, which also had a fleet of vintage coaches that it used. They were all in the books at £1. So we had to bring in an expert to opine on the value of the fleet of vintage buses. Dividend yield method, most commonly used with minority holdings where the shareholders have pretty much no influence and have to rely on dividends for a return. You can't use it for controlling stakes. And some industries have specific rules of thumb, but like stopped clocks, they're only usually right by accident. So you might find shops valued on a number of weeks turnover plus the stock, professional firms on a fee multiple. And rather topically, there is also a specific method for valuing football clubs, which I've blogged about recently. And recent funding rounds can't be ignored. But you do need to remember that they will be based on a particular investor's view of a particular set of forecasts. So I would say in reality, that's really a price rather than a valuation, and more on the distinction in a minute. So is valuation an art or is it a science? Well, according to valuation guru Damodaran of the New York University Business School, it's actually neither. It's not like physics and maths, which have immutable laws, does have principles, but none of them that meet the precision threshold for a science. On the other hand, valuation isn't an art. Much as I'd like to, I can't run wild with my creative instincts when I'm doing a valuation, and geniuses can't go off and completely reinvent the rules. He reckons, and I kind of agree, that it's more like a craft akin to cooking or carpentry. And you learn what works in valuation and what doesn't work, importantly, by doing it. So the moral to draw from that, I think, in your own businesses is don't get too focused on the spreadsheets, the discount rates and the theory, while losing sight of the commercial reality of the business. Price versus valuation. That's a truly important distinction. In the real world, of course, it's the price tag that you put on your business, price tag that is put on your business by a well-funded strategic buyer that's going to grab your attention. A valuation has to be more even-handed. I was at this point going to read you out the International Valuation Standards Council definition, but it's a bit dry, so I've decided not to inflict it on you. But essentially, it says you can't take account of a specific buyer with particular motives or particular funding, i.e. you can't take account of that strategic buyer you hope to sell to. You have to take a more even-handed, orderly market approach. So to illustrate that, it's probably the best way. I recently valued a construction services business which had been approached by an overseas buyer. They wanted a valuation which was used to inform the discussion, but alongside the valuation, we also did some work to indicate the likely range of price expectations in the negotiation, which was much higher, of course. And that indeed was where the offer came in. So it's the same inputs, but used differently, essentially. Or to put it another way, one of my favorite quotes from Warren Buffett, price is what you pay, but value is what you get. And that's where it's all to be won and lost, of course. Some practical valuation pitfalls for you to avoid. Unsupported multiples. I do surprisingly often see valuation reports with the magic words, in my judgment, before a multiple is just plucked from thin air. Beware valuers bearing multiples unless they have evidence to support them. Clearly, these guys haven't subscribed to MarktoMarket or don't have enough confidence to share their thinking. Don't place blind faith in the numbers. Valuations really need to be about the narrative as much as they are about the numbers. Another Warren Buffett quote for you, accounting numbers are the beginning, not the end of a business valuation. Poor benchmarks. Picking poor comparables is a classic problem. So be honest when you're comparing your business with others. Look for benchmark companies with similar prospects, growth rates, and return on capital. PE multiples applied to EBITDA. I do see that, and it gives a meaningless result. PE multiples, of course, have to be applied to after-tax profit. EBITDA times the multiple gives you enterprise value or the cash and debt-free value. And then, of course, you need to work through the equity bridge to get back to the equity value, which is the price you're actually going to get for your shares, taking into account working capital, surplus cash, and debt. And finally, data sources. Some valuers out there, amazingly, still just reach out to the FT for broad indices. But as you'll gather, we're pretty keen on the use of specific comparables. And we subscribe to a number of data sources, but we do like MarktoMarket, as it has a rich data set. It's easy to search and manipulate. And it's also good when you're looking for potential buyers for your business. But this isn't meant to be a commercial for MarktoMarket. As they say on the BBC, other data sources are available. And that's probably a good link to hand back to Doug.
Thank you very much, Lake. And as Lake says, other databases are available, but they're just not as good as MarktoMarket. And so with that, I will share my screen again. Okay, so the next bit that I'm going to talk about is just some specific drivers for valuation. And so what are the specific factors that could influence the value of a business? And two of the key ones are the sector the business operates in and the size of the business. And that probably doesn't come as a surprise to you. And it's something that I know the market scratches their head over quite a lot. And what we do to try to help is, as well as providing individual deal multiples on our platform, we bucket those multiples into size bands and sectors, so that we can then illustrate trends in the market in those particular size bands and sectors. So the first one is size, and what this slide is looking at here, this is actually data from 2020. So this is looking at 2020 as a whole. And it's looking at how what multiples were paid in aggregate in different parts of the market. And the market in this case has been split up based on deal sizes. So in the same way that you look at FTSE multiples for public companies, and you look at FTSE industry multiples, and you look at FTSE size multiples, small cap, mid cap, large cap, these are the mark-to-market indices. And we call our indices, our size indices start with the nano-cap index, which is companies that were sold for less than £2.5 million. The micro-cap index, £2.5 to £10 million. Small cap, 10 to 50. Mid-cap, 50 to 250. And we also give you an overall multiple, which is the multiples we were looking at before, and that was 9.2 times in 2020. And so that's quite a good reference point for what's being paid in these size buckets. So you can see here our nano-cap index in 2020 traded at 5.1 times. So the aggregate multiple paid for a business valued at less than £2.5 million in 2020 was 5.1 times. If you go up into our microcap index, so the next level, £2.5 to £10 million, that multiple moves up to 7.5 times. And then 10 to 50 million pounds moves up to 10.5 times. Now, hopefully from this, you can see the attractions of the private equity buy and build strategy I was referring to, because if you're buying an asset or creating an asset with this kind of value, or indeed this kind of value, small cap or mid cap, and you're buying bolt-on acquisitions down at this end of the market, you get that multiple expansion effect, where the profits that you're plugging in from the small businesses you're buying then attract a bigger multiple, because those profits become part of a larger group. So size, all other things being equal, size has a big bearing. This is empirical data showing how size will impact your valuation. The next thing is sectors. So in the same way that we bucket deal sizes, we bucket the deals based on the broad sectors that a target company operates in. And the broad sectors we have here are industrials and business support services, consumer, technology, media and telecommunications, healthcare, and financial services. And again, this is looking at 2020 data. The leader in terms of prices paid, and this is really consistent from year to year, was technology, media and telecommunications. And again, that maybe isn't a surprise. It's a pretty broad category, and within that category, you will see divergence in terms of what people are prepared to pay for a software company relative to an IT services company, for example. People will pay more, again, all other things being equal, will pay more for recurring software revenues relative to one-off consultancy revenues in an IT services company. TMT was followed by financial services, which traded just above 10 times, and healthcare just above 9 times. And then the laggards were industrials and business support services, and consumer took a big hit last year. So for, I think, obvious reasons, that consumer category has consumer services, hotels, restaurants, etc., as well as consumer goods, food and drink companies, and so on. So again, a bit like technology, media and telecommunications, within that category, there will have been businesses that might have been relatively robust if they were providing consumer staples, but lots of businesses that clearly struggled last year. So that's size and that's sector impact. But of course, there are lots and lots of other factors that are going to influence what somebody is prepared to pay for your business. And one that we think about quite a bit is growth. And the way that I have illustrated this is I found two deals on MarktoMarket for businesses that were broadly similar, that were acquired at the same point in time. And just to look at the impact of growth on those, the multiple that was paid for those companies, I deliberately chose deals that have happened some time ago. So in both cases in 2015. So we could look, we've got a nice 5-6 year illustration of how those businesses traded after they were bought. So the first company is a company called Wahanda. And the second company, the legal name of Wahanda is Hotspring. The second company is called Live Bookings. These are both digital marketplaces. So in Wahanda's case, it matches health and beauty practitioners with customers. In Live Bookings' case, it matches restaurants with customers. Wahanda was acquired by Recruit for £165 million, which represented a revenue multiple of 38 times. So I'm using revenue multiples because both of these businesses were loss-making. So clearly you can't attach an EBITDA multiple to these two. Well, you could, but it would be negative. So I'm using revenue multiples. So Wahanda was acquired for 38 times revenues. Live Bookings was acquired by Michelin for 7.7 times revenues. So two businesses bought broadly the same point in time. Not massively dissimilar fundamentals in terms of their revenues. Okay, one was at 4, one was at 11. Doing broadly the same thing, but the prices were materially different. And I think the reason for that comes down to the growth profiles of these companies. So what this chart shows is the multiple, the revenue multiple paid for each of these businesses based on subsequent revenues. So subsequent reported revenues of these target companies. And with Live Bookings, actually, revenues went into decline. I don't know the reasons for that, but revenues went into decline. With Hotspring / Wahanda, revenues continued to grow aggressively. And what that means is that the 38 times multiple that was paid for Wahanda starts to decline very quickly. So on a 2-year view, because of the growth in those revenues, that multiple, if you were to calculate the revenue multiple 2 years out, it was actually 15 times rather than 38 times, which was the same as the multiple for Live Bookings 2 years out, because Live Bookings revenues declined. And you can see that on a 5-year view, actually, Wahanda's, the blue line, on a 5-year view, the revenue multiple came down to 5 times, which suddenly looks, you may think that still looks expensive, but certainly a lot more modest than the upfront revenue. So that's growth. Growth has a huge, huge bearing. And people talk about growing into a multiple. And that's exactly what's happened with Wahanda here, Hotspring. So that's growth. And then there is the strategic acquisition. And this is when a buyer just has to have an asset for a specific reason. And I think that perhaps this transaction is appropriate, being based in Cambridge, being close to many of the participants on this call. So ARM, as you know, was bid for by NVIDIA, and if the press is to be believed, what I've certainly read about it is this allows NVIDIA to get their hands on ARM's R&D before the other customers. So it gives it this huge strategic advantage. And NVIDIA was clearly prepared to pay a lot of money for that, and in fact paid an EBITDA multiple that's completely detached from the fundamentals, 352 times, and a revenue multiple of 20 times. Actually, that revenue multiple of 20 times is quite similar to the multiple that SoftBank paid for ARM back in, I think it was 2015-16. The chart in the middle here, ARM valuation radar chart, this is another way to look at these more intangible aspects of a business. So, we've talked about how sector, how size of business, how growth can impact a multiple in a more quantitative sense. But these are slightly more intangible things that you can look at in a radar chart. And I know that Lake is going to talk about this as well. The basic principle here is that you take a bunch of factors and you score the business you're trying to value based on these different factors. So I did this with ARM, and I used growth, competition, margins, sector, revenue visibility, management, size of business, market size, legislative risks. And in order to provide some context to this, two deals that were announced, two other bids that happened around the same time as ARM, G4S, the security company, and William Hill, the bookie, I scored those companies as well. And when you look at the valuation chart, ARM is the light blue area, G4S is the dark blue area, and William Hill is the area within the white boundaries. And the basic message here is that the larger the surface area within the radar chart, the more valuable the company, because the larger the surface area, the higher the business is scoring on the different metrics, and therefore the more valuable the company. So you can see here, based on my scores, and I accept that the criteria I've used and the scores I've applied are very subjective, but based on the criteria I've used, the scores I've applied, ARM scores very highly and significantly higher than both G4S and William Hill, thus justifying premium pricing for ARM relative to those assets. But I know that Lake is going to talk about that a bit more. And with that, Lake, can I hand back to you, please?
Thanks, Doug. Apologies, everyone, just having a little bit of an issue on the screen sharing. Right, thank you. Thanks for your patience. In the first session, I tried to give you a look at valuation from a practical standpoint. The second one is a bit more about strategy. To be clear, this isn't about how you put together your overall strategy. You are best placed to do that for your own business. I'm going to look at it in terms of increasing the price that you might get for your business. And there's the themes: making your strategy work for you, how to be more attractive to a buyer, exit options, and exit planning. So, strategy. The world is pretty complex out there, lots of moving parts. But I think we need to try and keep things relatively simple. And classic strategic planning theory says that you create value, capture it, and sustain it. And that there's broadly three logics of value creation, which it's all about. And this is the first one on the screen at the moment, the strategy of the map room, which is about staking out your position and building barriers around it. So for a technology company, it might be intellectual property that's protected. In a military context, it might be capturing the high ground and fortifying it. Then there's the strategy of the storeroom. That's about capturing value through resources, which are rare, valuable, hard to imitate. So in a different sector, a business like Gucci with its designs and brands and scarcity value. The military analogy might be to have better military hardware than the opposition. And then there's the strategy of the battlefield. This is the idea of capturing value through opportunity. So you identify a gap in the market and you pursue that unmet demand for profit. This one's particularly suitable in growth markets, so a lot of the tech businesses around here, and also in volatile markets, which I think we can all say it's been pretty volatile of late. Now, I'm sure one or more of these will resonate with the way that you or your clients think about your businesses, but actually often the issue is not what the strategy should be, but getting it to happen. I think there's been quite a lot of research which shows that many strategic plans just either disappoint or fail to get implemented. And so I just like to offer some simple thoughts based on quite a large number of strategic planning sessions and follow-ups that we've done with businesses. And it's simple stuff. It's get your whole team to buy in, use of external facilitators or your chairman or someone within the business to draw out the strategy, keep it focused. If your strategic objectives aren't on the fingers of one hand, then some of them are probably not strategic. And then most essentially focus on execution and follow up. You know, someone's name and a date has to be against all the key action points that drop out. Another business guru quote to sort of encapsulate that, this time from Peter Drucker. He said, no decision has been made until carrying it out in specific steps has become someone's work assignment and responsibility. And until then, it's only a good intention. You see that so much. So the take home is don't let your strategic plans languish at the level of good intentions, make them happen. This slide is an anonymized version from a strategic exit planning session that we did with a technology and services business a couple of years ago. And the top half is a look at their current state and future state, where they needed to be to meet their objectives. And the actions in the gap fit with the key actions from their strategy, mostly in this business to address the imbalance between a large, lower margin services business and a growing intellectual property driven products business with better margins. The radar charts below, similar but different to Doug's one. These attempt to map the business then and in the future against key points that we feel will drive value. And these are all based on a big survey of SMEs in the States, which tracked these key features against the actual prices that these businesses were selling for. So 5 is good, 1 is weak. And on this one, for example, you can see that the business had great customer satisfaction and growth potential, but was pretty weak on owner dependence and also on defensibility of that big services business. On the right is where we were all trying to get to, having built out a second tier management, improved profitability, and built some recurring income. It's a nice visible way of showing the things that you need to action to make it all happen. This business went on to be sold successfully. The products division was sold to a tech buyer and the services business to a management buyout team. And it shows you can get these things to work to a relatively short order. It's just about getting focus and getting implementation. Another way it's useful to think about your business and valuation is through the eyes of a buyer. You know, how would a buyer actually look at your business? And again, based on lots of conversations, these are our kind of 10 top points that we think will be going through their mind, that go through our minds when we're looking at acquisitions with clients. So number 1, of course, financial performance. Is it sustainable? What are the risks? Are there any scale issues? Growth potential. How scalable is the business in my hands? Are there synergies? Do I like the customer base? Absence of dependencies on owner, suppliers, customers. Positive cash flow cycle. I'm pretty keen of a buyer that's not to have to pump loads more money in it afterwards, or at least to factor that into the price. Customer analysis. Any concentration I should worry about. How unique is the offering? How loyal are the customers? Obviously, I'd love to have recurring revenue, or at least consistency of revenue generation. Intellectual property is important. That's intrinsic value, isn't it? Key employees. How long do they stay? What's the culture like? What's the continuity like? Sector. Is this a growth market? Issues like exposure to imports, competing M&A activity. And then brand, if it's critical to revenue. What do I think about it? So that's how a buyer might be thinking about you as a target. Looking on the other side of it, in terms of exit events, what are the choices? Well, this is, I think, probably the key spectrum that people might be aiming at. Liquidation, generally bad news, of course, but sometimes if a trade is to be sold separately, that's a way to get the cash out of the business. Employee deals, very topical. We see a lot of people looking at these around succession, reward and retention. I could do a whole morning on these, but broadly, employee ownership trusts and buyouts do similar things, but have rather different tax mechanics and benefits. Mergers, true mergers rarely occur. It's usually one guy buying the other, which is a negotiated sale. And we are engaged in a lot of these at the moment where businesses have been approached by strategic buyers or that knock on the door. Obviously, you don't have the benefit of competition, but you can still get a good deal. We'd call that a kind of negotiated support assignment. The next two are similar, sale to trade or to private equity, often engineered via confidential auction. Quite often you'd put these two constituencies up against one another in an auction. This is probably what will get you the best price. I say probably because in some sectors it's possible to engineer a buyout, which would give you a better price than the trade. So it's a little bit sector dependent. And then of course IPO, complex, and you need to be a big business, but it can, again, in some circumstances, give the best price. And if you do plan to go on an acquisition spree, of course, it's great to have quoted paper with which to fund the deals. What about timing around all of this? This again is an example from a real session we did with the business. This one's from last year. When businesses are thinking about exit planning, we always say, well, where are you on the timing? What do the key factors look like and what color are the traffic lights? And in this example, you can see, for example, financial performance of the business and some aspects of COVID uncertainty put us on the amber list. Whereas on the other hand, the relatively benign still tax regime and the sector it was in were very much green lights. So it's a useful way of just thinking about what are the key things. And you should probably always be looking over your shoulder and thinking about timing, which is a nice kind of lead into the idea of more formal exit planning. Think of it as a way of managing the value in your business. And the approach needs to vary depending on how far out you are from your exit. Exit planning review is probably 2 to 10 years out. Pulling out key actions and expectations. What are the business owners' personal drivers? What does M&A look like in the sector? What about the financial trading? Key value drivers that will influence the multiple? How will a buyer look at the business? What price expectations should you have? So all the stuff we've talked about today around value. And what are your different exit choices and how realistic are they? And then that exit readiness slide, are you ready or do you have things still to do? Closer to the exit door, say 18 months plus, it's more of an exit readiness scan. And then it's about saying, okay, we've got enough visibility of the market cycle to make this decision, but far enough out still to do some stuff to the business. And the key questions would be, is the timing still right? What's happening in your company's market? What are the valuations in the sector attractive? How are they trending? Is your original proposed exit route still practical and preferred? What other performance improvements might you yet do to capture a bit more value? And really importantly, have you got some pipeline value creation initiatives on the go that could extend after the sale to the next owner? It's the classic, you want to leave gold in the ground for the next guy. So that's the end of this session. I think we're going to stop sharing my screen and hand back to Louise for questions.
Yes, indeed. Thank you very much, Lake and Doug, for the presentations there. It's stimulated lots of thought, actually. We've got a couple of questions which are in the chat, but if I may, I might just go to one, if that's okay with you guys, one that we had beforehand, because it's kind of, I think Phil's going to take this question. So how do you see the valuations and activity level trends for the rest of this year and beyond?
Hello, everyone. So I think the question's been answered in the main throughout the excellent presentations by Doug and by Lake. But taking a slightly different approach, one being what are we seeing boots on the ground in terms of transactional activity and conversations that we're having with strategic buyers and owners of businesses, private owners of businesses. And I think sort of valuation multiples are certainly going to remain steady. think what we're witnessing economically certainly is the release of a pressure valve, and there's lots of pent up demand out there in the marketplace. A lot of consumers have got, to borrow Doug's phrase, dry powder, in terms of money that would have been spent on consumables, would have been spent on products that hasn't been for all manner of reasons over the last 15 or so months. And so that then translates to a recovery in the likes of travel, leisure, hospitality, industry sectors and markets. I think Lake and I had a business that we were going to be taking to market just before the pandemic hit, and it was a leisure business based in Ipswich. And unfortunately, that business has gone elsewhere in terms of the day-to-day operations. Notwithstanding, if you kind of take a step back and look at the wider impact of travel, leisure, and hospitality, we'll certainly see a recovery in those sectors, and that translates to valuation multiples holding. Other defensible sectors, as already mentioned, likes of healthcare, likes of tech across the piece, and the likes of financial services as well. So I would say that valuation multiples will hold steady and indeed increase in the foreseeable future, for sure.
Excellent, thank you very much. There's a forward view there. We've got a couple of questions on multiples data. So how do you get your, and I guess this is for Doug, but feel free to portion it up amongst yourselves. How do you get your multiple data? It's not always available, is it? And the other one was about how do you get it without subscribing to data sources? So actually, Doug, you might not want to ask this one.
Yeah, well, maybe Lake or Phil can ask the second one. I mean, in terms of getting hold of the multiple data, yeah, that's absolutely right. It's not always available. I think a lot more is available than people realize. It's just very difficult to get hold of it, and you have to look in multiple different sources to pull it all together and to triangulate it all. So we spend a lot of time doing that here through tech and through our own team of analysts. And then we also get supported by our customers. So our customers will submit to us, and we're very grateful to them for doing this. They'll submit to us anonymized deal data. So it doesn't impinge on any confidentiality agreements they have with their clients, because we don't know the names of the parties involved. But they give us data that helps us analyze what's going in different markets. In the absence of a subscription to MarktoMarket, Lake, Phil, you're maybe better to answer.
Yeah, to give you I mean, the quick answer is you won't get such good data if you don't subscribe to something. You could go to the FT if you're not very imaginative. There are some other obvious ones like the private company price index, which is a pretty crude tool, which tends to overstate the outcomes because it's based on historic information. And the other thing that you can do is just reach out to Google. Most investment banks will publish some kind of broad stab at multiples in a sector, but it's fairly big picture. It's useful, and it's particularly useful for trends. But and we use it to help corroborate and sketch out the landscape. But we'd always lean first to the more specific data. So you can get some stuff that's helpful, but the real good stuff you've got to pay for.
Mm-hmm. I think we'll go to the question that was asked first up. So this guy's been waiting a long time, and it's about multiples again. How much of the multiple increase in Q1 21 is down to the race to beat anticipated ER changes? I don't know who wants to take that one.
Well, I mean, I can opine on that. And again, the other guys, they've got, as Phil said, boots on grounds. They probably got a better view. My personal view that turned it into a bit more of a buyer's market, because it was the vendors that were under pressure to get the deals done to pay less tax. So that would imply to me that maybe that wasn't much really what was behind the increase in multiples in Q1. It was other factors. But Lake, I tend
to agree with that. I think there are quite a few buyers who were very focused on getting the deal done, and they were a wee bit more pragmatic than they otherwise might have been on price. I didn't see any discounting going, and Phil, chip in if you want. I think it was more a case that people weren't hanging out for the extra 10 or 20%.
I think businesses are worth what a willing buyer and a willing seller are prepared to negotiate. So it's all well and good having valuation multiples to wrap over someone's head, but if someone hasn't got deep enough pockets or the strategic wherewithal to have that conversation, it's just kind of pointless, really. I think in terms of the question and the impact of kind of business asset disposal relief being manipulated by Rishi, our sort of experience at the time was predominantly buyouts, and so that kind of reinforces my point. It was in the main internal deals that were negotiated between the vendor and the management team who wanted skin in the game or ownership, or to take it on to the next level. And the valuation multiple, by and large, became irrelevant. It was down to what the two parties around the board table were prepared to negotiate. But I do take on board, the fact that the increased activity may lead to a conclusion that multiples then became sort of front of mind. But there's a difference between valuation and price.
Okay, thank you very much. We've got several more questions. We are going to hopefully finish at 12 o'clock, so we'll try and get through these as well. We're getting some questions coming in. So what are the biggest mistakes you see business owners making, aside from simply unrealistic or unsubstantiated valuations?
Oh, gosh, I'll have a stab and then pass it. Well, I think the biggest mistake that I see is people who get seduced into investing a lot of time and emotional energy into talking to potential buyers, where the deals then don't go anywhere, pumping a lot of the information out. Normally, one of the things we would hope to do with people is kill a deal earlier on, because you can just tell it's not going to happen. So I see that a lot. That's probably the main one, I would say. I mean, obviously, there's lots of, doing the deal too early because for whatever reason you've decided to go when you can see business with potential, but ultimately it's down to the choice of the owner.
That might lead on to this last question, actually. What advice would you give to a tech firm 1 year into a 3-year growth plan? Is this to attract attention now? Is that what the question? Have I asked that correctly?
Doug, do you want to go first on that one?
Yeah, well, I get attracting attention now from buyers, presumably. I mean, I suppose that, I can talk from the perspective of somebody who's sort of 4 years into 4 years into this, and we haven't really. All I can say is that we haven't really thought about attracting maybe we should be, but we haven't really thought about attracting attention from buyers yet, and it's. Why not? I mean, I don't know. Maybe Lake will tell me I should be doing that, but there's too many for me. There are too many other things to think about. Mainly growing the business to a place where I think it will be potentially attractive for those kinds of discussions. And I think, if I'd started having, I think it would have been difficult for me to have those discussions kind of after a year. And maybe I'm misunderstanding the question. Maybe you've been around for a lot longer than a year, but you're into a new growth plan. But certainly I don't think I would have attracted that much attention 1 year in. I think it would have been a distraction for me to been having those discussions a year into our development.
I think you're absolutely right, Doug. I think the key is to keep control of your own destiny. And for example, we're working with a cloud telephony business at the moment on a fundraise. And what has been an eye-opener for us is the amount of approaches they get from corporates and well-funded private equities, most of which are just going to waste their time. So I think probably building visibility rather than attracting attention is probably pretty useful. And I know some companies specifically go for making sure they're really visible in their own trade in the 2 to 3 years up to their planned exit date. But I'm a great believer in trying to control it yourself. I mean, somebody might turn up tomorrow and make you an obscene offer and you end up doing the deal. But as I say, to come back to the last question, I do see people getting very distracted by all of this. So if you can put a shape and a structure on it, that's helpful.
Brilliant. I hope that answers your questions. How do you build comparables? Here's a deep tech question. How do you build comparables where there are no sector comparables to be had, e.g. completely new market segments, which is common in deep tech?
That's a great. Can I have a stab at that, Lake? Because I really like that question, because we get a lot of people saying to us, okay, I've looked on your database and I can't find any M&A events for blockchain companies. You don't have any data. And my response is, well, that's because we haven't seen any M&A yet for blockchain companies. So, we can't make it up. We can't make up comparables where they don't exist. So I like that question. I think that the way that one of the ways that we're trying to address that is building, we're launching a new data set, which is for fundraising valuations. So as well as M&A valuations, you'll be able to see, okay, well, here's a bunch of blockchain companies that have raised capital at these valuations. They haven't been acquired, but they've raised capital at these valuations. So there may be some reference points there. And then maybe I think what some of our customers will do is say, okay, well, what's a pretty good proxy for this? So if I've got I talked about digital marketplaces earlier, or subscription-based models. I may be valuing a company that has a subscription model for coffee. I don't have any coffee subscription businesses to use as comparables, but I can use some other kind of, something with a similar business model that's selling something different. I think with the deep tech stuff, I think that is really tricky. But I think that, again, if I could just talk about what I think some of our other customers are doing is kind of working back and saying, okay, here's a new segment. We don't know much about, we don't have much in the way of comparables at the moment, but what is the opportunity for this company? Where do we think this company could be in, say, 5 years' time? What do we think the revenues might be in 5 years, or the EBITDA or whatever? If the revenues and EBITDA are at that level in 5 years' time or whatever, what kind of enterprise value can you attach to the business? And then you work back from there and say, okay, well, I need to be making 5 times my money on this, or 10 times my money, or doubling, or whatever. And you work back to a valuation today. Lake, how do you deal with that?
Yeah, very, very briefly, because I'm conscious of time. Yeah, I entirely agree with all of that. You have to develop some kind of narrative. You have to get, if you can, some surrogate benchmarks. So yeah, where is there another business that has a similar type of income stream? And then develop a reason why your business should be more or less valuable than it. And build it up, and probably use some DCF as well. But that's where your narrative about what's it going to be worth in 5 or 6 years' time comes in. It's about constructing a story, but you probably end up being not quite such a solid number as when you do have pre-established comparables. But I guess that's the excitement about a genuinely new sector, isn't it?
And I think you've just demonstrated that valuation of companies is not an art or a science, it is a craft. And I think you've both demonstrated that really well. So thank you very much. I will bring it to an end there, as we're just over. People are shifting off. So thank you so much. Thank you to Sean, who hasn't spoken today, but is from PEM Corporate Finance, for introducing us to Lake, and then on to Doug Lawson from MarktoMarket. It's been a fascinating session. So thank you so much for your time. Thank you everyone for coming. We have been recording it, so we'll send the link out ASAP when we've processed it. And if you want to hear about more things that are coming up, we'll probably put a sign up note on the follow-up email as well. But feel free to get in touch with any of us, and if you want to get in touch with our speakers, I'm happy to forward the messages on. So thank you very much, guys. That's been fantastic, really interesting, and thank you so much for doing the talk for us today.
Thank you.
Bye everybody.
Thanks, Louise. Thank you, everyone.
Bye.